How much does inventory cost? We've talked about that you include all costs to get that inventory on the shelf in the cost of the inventory. Now, we also need to look at the cost flows. And we know that regardless of the inventory method you use, that the beginning balance plus net purchases has to be allocated or assigned out to either ending balance or cost of goods sold. So how do we do that? Well, if it's something exclusive or unique, then we use specific identification. So, for example, cars have VIN numbers, jet airplanes, I'm sure, have serial numbers, and diamond rings are unique. So we use specific identification for them. But for other types of inventory, especially commodities, which are kind of interchangeable parts, we can use either average costing, FIFO, first in, first out, for cost of goods sold, which means last in, still here, is the ending balance. So think about FIFO-lish. Or we can use LIFO, last in, first out, for cost of goods sold, and FISH, first in, still here, for the ending balance. So using periodic inventory, let's do the following problem. And you can see we're going to do it over 2 years. So each year we'll figure out what the ending balance is and the cost of goods sold is. So first let's look at FIFO. FIFO says the first ones in are the first ones sold. So if we lay out what the first purchase was, the second purchase, we get the cost of the goods available for sale, or 30 units at $340. Now, we're going to allocate those 30 units between those units in ending inventory, 15, and those units in cost of goods sold, 15, based on the assumption that the first ones in are the first ones sold. So cost of goods sold is made up of that first purchase plus 5 units of the second purchase. That means the remainder, or the 15 units remaining from the second purchase, are in ending inventory, or 15 units at $12. Well, when the year ends, so when 2013 ends and it becomes 2014, ending inventory for 2013 becomes 2014's beginning of the 15 units at 12. We make 2 more purchases, so in 2014 we have to allocate out 40 units between ending inventory and cost of goods sold and assign a dollar value to each. Again, we use FIFO-lish. FIFO, the first ones in, are the first ones sold, and lish, the last ones in, are still here in ending inventory. So if you need to take a look at this, just pause and study it some. The next approach is LIFO, last in, first out. Now we don't stock our shelves LIFO, but we do when we're doing the beautiful financial statements, use LIFO for a variety of reasons, which we'll talk about in a second. But let's look first at the mechanics. Again, same situation. We have 30 units in the goods available for sale at a total value of $340 in 2013. And we need to allocate that cost between ending inventory and cost of goods sold. So notice that cost of goods sold is the last ones in are the first ones out. In other words, 15 units at the purchase 2 of $12. And what's still left is FISH, first in, still here, or the first purchase 10 at 10 plus 5 at 12. When 2014 begins, the ending inventory for 2013 becomes the beginning inventory for 2014. So the 15 units in beginning inventory are made up of 2 layers, 10 at 10 and 5 at 12. We then make 2 more purchases, so in 2014 we have to allocate between the 40 units available for sale $515, and we'll do that based on LIFO for cost of goods sold. The last ones in are the first ones out, and ending inventory. Fish, first in, still here. So again, looking at those layers, notice we're allocating out the cost of the goods available for sale and assigning it either to the ending balance or to cost of goods sold. The third method you can use for periodic is average cost, or also known as the weighted average. Here again we find our cost of goods available for sale, but now let's take a weighted average where we take the cost of goods available for sale in dollars, 340, divided by the cost of goods available for sale in units, or 30, and we find our average cost is $11.33. So our ending balance will be valued at 15 units at $11.33, and the ending for 2013 becomes the beginning for 2014, and cost of goods sold receives the remaining money. So when we turn to 2014, again, we find our cost of goods available for sale, both in dollars, 525, and in units, 40, and we find the average cost is 13 and 12.5 cents. So ending inventory will be valued, those 20 units in ending inventory, at $13.12.5, or $262.50. Cost of goods sold receives the remainder. So to recap this, notice that our income statement, whether we're using FIFO, LIFO, or average cost, has varying gross margins and cost of goods sold depending upon your cost flow assumption. Weighted average, FIFO, or LIFO. Also that our balance sheet's ending balance differs, again, depending upon your assumptions. So that is periodic, FIFO, LIFO, and average cost. Let's stop here and we'll come back in a second for perpetual.